Hi, welcome to today's webinar. We are going over Section 199A, or otherwise known as the 20% Qualified Business Income Deduction for pass-through entities. It is one of the better changes and yet one of the more difficult regulations to qualify for that came out of the tax reform of 2017. Generally, a qualified business with qualified business income that meets the limitations assigned by Section 199A is allowed a 20% deduction of their qualified business income for their sole proprietorship or LLC when it is treated as a single member LLC, partnership, or S Corp. However, whenever you see quotation marks within the tax code, always ask yourself why. What does that mean? Does the IRS have a different definition than the rest of us would? Most likely, they do. So, Section 199A of the tax code. We are going to go line by line and try to make sense of what it all means. Just kidding. I have already done that and organized it into a format more understandable. Generally, there are two qualifications that must be met to qualify for the 20% deduction and two limitations to the amount the deduction cannot exceed. Entities must meet the qualified business test. To meet this test, an entity must be a trade or business other than a service trade or business or the trade or business of performing services as an employee. A specified service trade or business is any trade or business involving the performance of services. In other words, 80% of small businesses I can think of would not qualify for the deduction under the very first test. Engineers and architects don't fall under the definition of a specified service trade or business and therefore would qualify for the deduction. An entity must have qualified business income to qualify. Qualified business income is income that is effectively connected to the trade or business in the United States. Certain investments, including capital gains, are excluded. Compensation to the taxpayer is also excluded, and special loss recapture rules apply. The two limitations to the deduction are W-2 and property limitation, in which the 20% deduction shall not exceed 50% of W-2 wages or 25% of W-2 wages and 2.5% of qualified property, whichever is higher, and taxable income limitation, under which the deduction cannot exceed 20% of taxable income reduced by capital gains for the taxable year. So, are there any exceptions to this general rule? Like Bill Ressler used to say, for every general rule, generally, there is an exception. And Section 199A is no exception to that exception. A service trade or business will be considered a qualified trade or business if taxpayers' income is below $315,000 for joint filers and $157,500 for all others. The limitations also do not apply if the taxpayer's income is below these thresholds. These thresholds will be adjusted for inflation, and the qualification tests and limitations will start to phase in for taxpayers with income above the stated thresholds, with complete phase-in at $415,000 for joint filers and $207,500 for all others. That is it for the newly enacted qualified business income deduction. Tune in next time as we discuss itemized deductions post-tax reform. Until next time. Yep, I think that made sense. If you haven't yet, check out my last webinar on the tax reform changes to the 1031 transactions.